This is a Physician Real Estate Roundtable. One of my inspirations, I'll give a little introduction to myself in a minute. I was a medical sales rep for over 10 years, and I saw a couple physicians that were cardiologists making $2 to $3 million a year each, and they were working 80 hours a week. And I just thought, I love they're making great money, but the quality of life just wasn't there. And so it kind of really led me on a path to learn about passive income, to start to develop over time ways to grow my wealth. I've raised now about 40 million for different deals over the years. The author of this book behind me called Fire Yourself. So if you're interested in firing yourself, just put fire yourself in the chat. And, this is what we're going to talk about today, about developing streams of passive income. If you are a physician, if you are a business owner, if you're a high earner, your hourly time is valuable. It's not worth buying single family houses. It's not worth managing a portfolio yourself, typically when you can make more money in your job. So learning about passive investing is super valuable. So I've got a few good friends here with me that are physicians. We're going to welcome them up to the stage here now. So we got Buck Joffrey of the Wealth Formula. Welcome, Buck.
Thanks.
Good to have you. And Tom Burns from Carbon Real Estate. Carbon all the way from Austin, Texas.
Thanks, Bronson.
Good, great to have you. And I see you got your guitar in the background. So if it gets a little dry, you can strum a little bit for us.
Liven it up.
Love it. And then we've got Vikram Raya from Viking Capital. Welcome, Vikram.
Hey, Bronson, thanks for having me.
Guys, we were talking earlier. I know Buck and Vikram especially are big biohackers, and they do a lot of this biohacking as well. If anybody's into biohacking, drop something in the chat there so I can see it, because we're thinking about doing a biohacking panel. And Buck actually has a podcast. It's a new one that he can share a little bit about biohacking. So if you're interested in that, longevity or biohacking, stick that in the chat and we can kind of see that as well. Awesome. Well, we'll go ahead and get started here. So the reason we did this panel, I talked about, physicians in general have unique challenges. Typically, are very high earners pay typically the most in taxes, particularly if you're in a place like California. You're paying a lot of times over 50% in taxes, giving a lot of it back. And so I know for each of you guys, it's led you on a journey to discover growing wealth, through real estate, through other assets. I know some of you guys are doing different things as well. But let's just talk for a minute. We'll kind of go around the circle and just talk a little bit about kind of your journey as a physician, just briefly, and then kind of what you see physicians face when it comes to passive income, and just even when it comes to work and trying to make money, as Warren Buffett says, while you sleep. So maybe we'll start with Tom on this one.
Yeah, sure. Mine started a long time ago. I've got the most gray hair of this group. I started back in my training, kind of learning, and really just decided to jump into real estate because it moved slow enough. I was too dumb to do anything else. So I got into real estate and I kind of did those two things together. And it's worked out pretty nicely. Just kind of started slow and learned, and, things grow organically. I just wanted to have control of what I was doing. I quite frankly didn't want anybody to tell me what to do. So I wanted to have options, and I didn't think the guys that were training me had options. They were complaining and whining about their jobs. And this was quite a long time ago. Things have changed a lot, I think, in the last few decades, and physicians are, they're getting pressed more for time and getting sort of paid less per service. And their time's getting squeezed. And so they need to find a way to create some passive income. And there's some nuances to how they can do that. They may not have the opportunity to go out and do some of the stuff on their own. It's going to require some sort of teamwork, such as with a syndication or with partners or something like that. But there's always a way, there's always an option.
Absolutely. That's well said. Let's go to Vikram.
Bronson, I think we've shared my story before, but really briefly, it was similar to many of the guys here, Buck and Tom. Like, we were passionate about medicine, and we really care about patients, and we really loved what we're doing. But we just noticed there's some ceilings, there's some handcuffs, there's restrictions in capabilities. Freedom really is what I heard Tom, and that really resonated with me. It's I didn't have the capability to fully unleash all my my skills and my energies as a cardiologist. And so I initially dabbled in real estate, not really thinking of anything of it more than just a side hustle, if you will. And the real reason I did that is because I wanted to eventually start my own clinic. I studied in functional medicine. The goal was to create like this clinic to sort of reverse disease instead of just manage it as a cardiologist. But I thought it was very risky to do. And so I attempted options trading, and I got my butt kicked.
You and me both, man. I lost $70,000 in one day. So I learned I'm not a good options
and then
trader.
I tried all these other things, wholesaling, flipping homes. I mean, it was, none of it really panned out. And so finally I came across like, okay, single family homes and fix and flips. And then I saw the light and said, hey, this is not really a scalable thing. What is scalable? And it was multifamily. So I was like, okay, that makes a lot of sense. And so I was doing that, but it was still a side hustle. And the goal was to really expand this medical practice and clinic. But then the benefits of real estate started pouring in. And, I realized real estate was sort of an elf activity and not a half activity. And I'll explain that to your audience. I think elf activities are easy, lucrative, and fun. And half is hard, annoying, lame, and frustrating. And I noticed, a lot of things in medicine are half. they're challenging, and it's either bureaucracy or restrictions or just it's an industry that doesn't like to be disrupted. And so no matter what you have, it's challenging. So I noticed with a little input on my own, real estate just sort of took off. And so I sort of started giving more and more energy to it. And now, knock on wood, a couple of years later, we've been able to successfully retire from medicine, and I really enjoy what I do in real estate. And, I have other interests outside of real estate, but it's because real estate's so freedom giving that you're able to do multiple things.
Yeah, absolutely. It does really give you that lifestyle that a lot of us want. Buck, why don't you add, what do you have to add there?
Oh, well, I mean, my story is a little different, right? I mean, I went to medical school because essentially because I was kind of a science nerd, biochemistry, molecular biology guy, was thinking about getting a PhD, went to medical school because it was like, something as a next step. And I did that and ended up as a neurosurgical resident. And then I pivoted into otolaryngology head neck surgery and then did a plastics fellowship. And then I only practiced for 7 years after all that training. And the reason for that is what happened to me was I pretty quickly realized that I was a doctor, of course, and a physician, and I love science. But at my core, I was an entrepreneur, and so I'm more of an entrepreneur who happens to be a doctor, rather than a doctor who pivoted into entrepreneurship, right? I think so. So what happened for me was that when I started practicing, I went in full bore cosmetic surgery. I didn't want to wait and build a practice. I started I went head first. By the end of my first year in practice, I was spending $1 million a year in marketing, and I was making a lot of money. At that point, real estate came in for me because I needed to figure out what to do with my money. And I came from a real estate family, and my dad is an immigrant, and grew up dirt poor in India, came here, and he became a millionaire in the 80s from real estate. And that's all my family's ever known. So when I started investing money, it wasn't really like, well, gosh, should I do this? Should I do that? My parents were like, well, don't be an idiot, buy real estate. Right. So very different. So a lot of people grow up kind of like this feeling that real estate is kind of the risky thing, the alternative thing. I grew up thinking that was the safe thing. And so I bought a bunch of real estate in Chicago where I was practicing, and small apartment buildings mostly. Those blew up, in a good way, just because of a good luck, frankly. I bought at really good times, and in these areas that we're growing quickly, and made 500% returns on everything within a few years. It was like, wow, this is cool. I started podcasting about the stuff, Wealth Formula, and about 9 or 10 years ago at this point. So it was a long time ago. And from that group, started telling people what I was interested in, and then started an investor group from that, people investing alongside me. And, through that, accumulated probably, over $1 billion of real estate right now. So that's my story in real estate. Oh,
It's like I was muted there. Yes, I was saying having a good line with myself. So what I want to say real quick, if you're not familiar with each of our panelists, they've each raised hundreds of millions of dollars for real estate deals, been doing this for many, many years. I love talking to, obviously we have this idea, for even those that are not physicians, that a physician, typically you got to be pretty smart to get through medical school and be able to treat patients and to do all that. I wanted to say for somebody who's a newer investor coming into this, everybody knows they should have bought real estate. They should have bought it 10 years ago or 20 years ago, whatever. The best time to plant a tree was 20 years ago. The second best time is today. Let's take a minute and just what is it looking like, kind of both from the macro, like what's happening right now in the economy, and how does that affect real estate, especially multifamily? I know you guys are all involved in multifamily. Tom, you have some other commercial stuff you're doing as well. Can you talk about, is this a good time to invest? And, maybe just share some thoughts. We'll start with Tom. We'll work our way around there.
Yeah, sure. It kind of depends on who you're listening to, right? Are interest rates going to start coming down, or are they going to pause and go back up again? So it's an interesting time, and it's a time that we all, probably all three of us on this call knew was coming over the last 10 or 15 years. It's just that we had a 12 to 14 year fairy tale run. So just a little hiccup here. I think that economy wise, I'm not smart enough to know where it's going to go. But you talk to one person and it says, we're headed towards recession. We talked about that with our little Harry Dent story before. You talk to others, we're going to have a soft landing and kind of move on. Either way, in the now, there's in the real estate world, there's always opportunity. And for the last 10 years, you could throw a dart and probably make it with an apartment complex. Now you've got to be a little more discerning about what you buy. But there are deals. I think probably all three of us out there realize there's some deals out there now and there's some discounts. So the multifamily world is always good if you know what to look for and you know how to underwrite the deals or who to invest with. I think the trend and the reason, I used to be a developer and now I'm switching more to acquisitions. So after 15 years of that, but I think that there's going to be a bit of a flood of product over the next year or so. I think about the middle of 25, we're going to see that supply drop off a cliff because the starts in multifamily dropped between 52 and 74%, depending on who you listen to. So people stop developing, they're starting up again now, but that's a 2-year train. So there's going to be a gap. And so rents, I think, might be flat for a while for the next year or so, but I think properties that get picked up now are going to see some velocity in their rent growth as they start hitting the back half of 25 and through 26 and 27. So if you buy right and kind of know what you're doing, I think you'll do fine. And that's with all real estate. As you said, yeah, it was great. Would have rather bought what's available now in 2015, but there are still deals today that will look good 5 years from now. They'll look back and say, I wish I'd have bought that back then. So let your education be your hedge.
It's always deals in every market, right? You mentioned
Right.
Harry Dent. We had him on this panel actually about a year ago, and it was like a Jerry Springer show. So if you're interested in watching that, I just put that in the chat. So if you want some fun watching after that, it was pretty funny and entertaining in a very good way. So Vic, what are your thoughts?
Yeah, thanks, Bronson. The Jerry Springer comments, hilarious. I have to think about time horizons, right? Like if you are from Japan, they don't have a 5-year business plan or 10-year business plan. They have a 100-year business plan usually for their companies. And so, in our country, we're very, more short-term oriented. And so if again, most real estate is going to crush it in like 10 years, 20-year time frame. And so having that sort of as a backup perspective is interesting. But that being said, I have a person on my team we brought on, and he's our asset manager, and he's been in the industry for 30 years. He's been through obviously several market cycles. And so I sometimes, lean on him and ask him, hey, dude, what have you seen throughout all these market cycles? And the interesting thing he told me, and his name is Ed, he goes, Ed, he goes, what do you see? And he goes, I usually see 2 years of down years or flat years, and I usually see a 7-year uptick. And we're sort of in that same cycle here. And then, I was at the Best Ever conference out in Salt Lake City, and I was talking to our friend John Chang from Marcus Millichamp, and he made an interesting point. He said the Blackstone acquisition, the $10 billion acquisition that they did of multifamily, he thinks that's the first domino to fall in this next economic upcycle for real estate, specifically multifamily. I'm like, so our investment thesis at Viking is we're rooting for rates to stay up, because the longer they stay up, there's less institutional people coming in. A lot of the small people are still on the sidelines. There's so many people still just waiting, pencils down. And for people who've been through cycles, and I know Buck has for sure, and Tom has as well, they're looking at this as one of the most interesting, buying opportunities, we've had in a while. And so I wasn't around when 2008 was there in multifamily real estate. And so I'm looking at this is my opportunity to get in at a reasonable cost basis. And so there's two types of plays we're looking at. One is a cost basis play, meaning, we're looking for finding a deal in Austin or around Austin that's 148 a door for 2012 vintage property. Normally build cost of that is 250 a door, right? Or I'm finding deals like in Atlanta, for example, where the cash on cash makes a lot of sense, and it hasn't been making sense for almost 2 or 3 years. And so those are the two types of plays I'm looking at real estate wise.
Yeah, I think there's a lot to be desired from, when you buy, obviously your buying price is fixed, but later your interest rate can be adjusted. And so we're seeing discounts in some, especially multifamily, 20 to 40% in some markets. So it's actually most markets. So Buck, sorry, I've got some major construction going on in the background. Here's some tapping that's on my end. Buck, give us your thoughts. What are you seeing right now in the multifamily or real estate market particularly?
I guess you'd talk about it at a few different levels, right? First and foremost, there's always deals for people who want to buy deals, and this may not be the kind of real estate that I do right now, right? But the whole saying about how real estate is local, your market, what's on sale, what's not on sale, and that kind of thing, and it just has to pencil out. Now that is always going to be the case, no matter what's going on in the big world of real estate. Now, in my world, where we're dealing, with typically assets that are 50 million and above, multifamily. Right now, the situation is there is very, very little liquidity in the market. There's not much to underwrite. And the reason for that, as you mentioned a little bit, Vikram, is that the institutional players are out of the game. They're not there right now. The BlackRock thing could spark something, but I doubt it in the short term. And the reason being that what we're seeing is an instability in cap rates. The cap rates were going to, they really haven't settled, and they haven't settled because the treasuries haven't settled, right? They were settling down. We were looking at the 10-year treasury about 4.25 for, I don't know, for a few months there. And it started to look like things were going to settle down. And when that happens, then you can get some sort of stability in cap rates. But then last week, of course, or was it this week? I don't know. Last week, there's a spike in inflation. And the next thing you know, 10-year treasury is up near 4.7 today, right? So the point is, if you're underwriting big deals, what do you underwrite with, right? You have to use a cap rate. You have to use some assumptions on interest rates. And if you don't have those variables to reliably underwrite with, then you're not going to do it. So the smart money is mostly out of the game for that reason. And then sellers, well, hey, if you don't have to sell and you bought at you bought at the top of the market, you're not going to sell. You're just going to hold on and wait, right? So that's what's going on in right now. From my perspective, there's very little to underwrite. There's like if the big distress things are going down in smokes with $100 million or say like thousands of units at a time, like they're defaulting and then they're getting bought up by REITs. There's not a whole lot of space for guys like us right now who are buying 50 to $150 million assets at a time, right? Now, what's interesting though, and I think this is something that I gotta mention, because I had this really interesting conversation with a guy today by the name of Campbell Harvey. Campbell Harvey was the guy who first recognized this concept of the inverting inverting rate curve, right? So essentially, when bonds, the 10-year treasuries, and the short-term debt flips, right, and it like it is right now, the inverted curve, and that is predicted, I think, 8 recessions since the 1960s. And I was talking to him about it, that in specific, but he pointed out something that I thought was really interesting. So if you look at the CPI numbers, the inflation numbers from last week, 3.1%, and it kind of spooked everybody because that was up. And then the treasury spiked right after that. But one of the things that he pointed out there was that the Treasury, the CPI used for shelter inflation, for basically rent inflation, they use 6% as the number. 6%. Who in the world is getting 6% right now? Tom, are you getting 6%? Are you raising your rents by 6% right now?
Not even
No.
close. No, they're flat,
Not even close.
practically.
Not even close. And the reason they are using that is they use a certain type of data point, which I'm not going to get into. It's effectively a lagging data point for interest, or lagging data point for rent increases. If you look at the real rent increase numbers right now, if you use Zillow, it's probably around like 2.5, something like that. Apartments.com, I mean, like, you could use these basic things. It's like 0. Bottom line is it's pretty darn flat. That number of rent increases makes up 70% of the CPI. So if you use actual numbers from today, and let's just say it's actually 3%, okay, 3% instead of 6%, CPI is at 2.1%, which is right where its target is, right where the Fed's target is. What that means is, if this is a lagging indicator, that 6 months from now, CPI should essentially drop off a cliff. And if it drops off a cliff, we're going to see rate cuts. Now, I'm like Tom, I don't like to predict the future, but that is some pretty interesting data. And certainly for me, it's encouraging. So,
yeah, it's a great point. So we're going to leave some time for questions. I know there may be some questions at the end, and I know we have some physicians, some non-physicians that don't. This is a panel just to get information about real estate and talking about, tax strategies. So there's a lot of common issues a lot of people have. So I hope everybody speaks up when we have Q&A in a few minutes. Want to ask, for a lot of high earners, particularly physicians, lawyers, CPAs, a lot of people, they pay a lot in taxes. Let's talk a little bit about some strategies around reducing taxes. Now, disclaimer, I know none of us are tax professionals, but maybe you can just talk about your experience or experiences of investors that you've worked with. So let's start with Tom. We'll work it around the horn there again.
Yeah, like you said, not a tax professional, but in my journey, I used to joke that I used to get these K1 showing losses, and when I finally understood what that meant, I used to run through the house and show my wife how much money I lost this year. So that was a nice benefit. I didn't start the real estate game understanding taxes or knowing that it was useful. But over time, incrementally, it started just chopping down my blended tax rate. And so, and then now all three of us are now getting most of our income, or if not all of our income, through real estate. You can shelter it all. So real estate's got a lot of benefits, and the tax benefits, the cost segregations, the depreciation, operational costs. You can run your life on distributions from your property and not pay any taxes, or defer your taxes indefinitely. And if you're a W-2 employee, you don't necessarily have those options. There's 1 or 2 options that you can use to shelter W-2 ordinary income. And so I typically suggest to people that while you can't use it all, you can hold that stuff for later, and you start developing the tax benefits from real estate. And over time, like anything, it'll compound. It'll start decreasing your blended tax rate, and then you can decide if you want to keep earning money in an ordinary fashion, or if you want to get it all passively or through your real estate portfolio. So taxes are wonderful. Every bit you save is money right in your pocket.
Yeah, I realized after a while, when I was making 200K in medical sales, I could make 140, 150, and it was kind of the same based on being able to be a real estate professional and finding depreciation, other things as well. Vikram, what are some things that you've learned about taxes?
Yeah, I'll go a little tactical here. There's 2 specific scenarios that maybe some of the medical guys here, and they don't have to be even medical, but any W-2 earner can follow. There's a short-term rental loophole that some people know about. It's essentially getting a short-term rental, and that year that you have it, if you do 100 hours of participation, you can claim rep status, which is real estate professional status, and that allows them to take the passive losses or the bonus depreciation from the short-term rental and offset their active income. So it's harder sometimes to do as a full-time, like the typical rep status, which is 750 hours. uh, doing traditional real estate, but I have I have a coaching client who's his wife's a physician, and he's a senior executive at IBM, and he's just is a beast at documentation, and he's able to claim rep status at the 750 hours still working full time at IBM. So there are ways to do it, I guess, but those are two ways in using the reps. And then the other strategy is, as Tom eloquently talked about with the bonus depreciation, you can use that to offset passive income. And a lot of physicians, for example, have something called ASCs, or ambulatory surgical centers. And some of the sale of that, or some of the money coming from that, can be offset by your real estate losses. And so essentially, that's a huge amount of money coming in for these physicians that they're now able to take tax free.
Yeah, that's amazing. The rep status is awesome. Now, you said I use that status. That's what I use to reduce my taxes. But you said something about 100 hours. Did you say there's a way to do something with 100 hours? Can you just explain that one more time again?
Yes.
It's
So
technically not rep status. That's just short-term rental. It's not
Short-term
the
rental.
tax code.
Okay.
Yeah.
Yeah, it's considered a loophole,
Yeah.
in the tax code. I don't know for how long it will be there, but I know that I have a lot of clients that are utilizing that as a way to get rep status without doing the traditional way that we've talked about.
Yeah, that's awesome. Thanks for sharing that. Okay, Buck, give us some of your thoughts. And we
Well,
talk
I
about
want to,
infinite banking as well. I know you have some stuff you're doing in that space.
yeah, we could talk about that, but I'd rather, create some value here for people, because I think if we back up a little bit, I just want to, because we're using lingo. I don't know if everybody knows this lingo. So do you mind if I define it a little
Sure.
bit?
Yeah,
Like,
absolutely.
okay, so first of all, we talk about if there's some confusion out there, because I mean, I didn't know this stuff until I started getting into real estate, right? There's different kinds of income. And the kind you're getting right now is from your job is ordinary income, W-2 income. And the type of income that you're typically getting from real estate is passive income. Now, income is great of all kinds. You're gonna, but the issue is when it comes to real estate, you're also often getting something called depreciation. Now, what is depreciation? Depreciation is what it sounds like. It's the Even though your real estate is probably going up in value, the IRS recognizes it as losing value on a yearly basis. So for multifamily residential real estate, that's 27 and a half years. So basically straight line, the value of your property, you get a deduction every year, cut it 27.5 years all the way down. There's ways to accelerate that called the cost segregation analysis. And that's where some of these huge opportunities for losses come. So real estate investors end up, despite making money, in many cases at the end of the year, getting a K1 that's showing a big loss. Now, the issue is that they are passive losses. They are not active losses. And that's important because passive losses cannot be deducted from ordinary income. You basically have these buckets as church and state. So you might have made $100,000, of income on one side. You lost $100,000 on paper from passive income on the other side. You can't combine those in most cases. And that's the challenge, right? Now, what these guys are talking about, which is brilliant strategy, relates to how do you create a bridge from ordinary income to passive losses? How do you use passive losses against ordinary income? So one of these things that they're talking about is the real estate professional status. Now, the IRS recognizes a status. It's your job. Real estate is your job. And I'm not talking about a real estate agent, a real estate owner, somebody who actually, owns stuff, takes care of it. And for that type of person, those passive losses become activated. And what that means is if those passive losses are activated, they can be used against any other active income. Let me give you an example here. I'm a real estate professional. And I have tons of losses. But I also have, 7-figure income that is completely unrelated to real estate. I can use my losses because I'm an REP. I can use all my losses from my real estate against the rest of that income because my designation is real estate professional. That is the magic, right? That's like the holy grail. One last thing, because I don't want to take too much time. One of the best ways to do this is if you have a spouse, if you're like a physician or a high paid W-2 wage earner who has a spouse who doesn't really want to work. Because frankly, if you get into real estate and you file jointly with one side being a real estate professional and one side not, then you can combine, you can file essentially and use the real estate professional status for up to about $500,000 worth of losses. Anyway, hopefully that was helpful, but I just wanted little nuggets there.
Yeah, absolutely. Now they're apparently sawing the house in half behind me over here. You probably hear some saws in the background. So good timing. Yeah, it's really great. I've seen some really magical things. I saw a couple clinicians in California have a $5 million sale of a business. So they're taxable. It's about 2.4 million they were going to pay in taxes, and they got it down to 125K through this real estate professional status with their spouses being real estate professionals, and then doing other creative, like a conservation land trust. And there's whole strategy groups. If you're somebody who's interested in tax strategy, there are fee-based tax or, firms that can help you. And actually a guy I'm not going to point him out, but a guy who's on this webinar live, if you're watching a replay, he's on here live. His wife is a CEO of a company, and he was working in the medical field, and they found out he would make more money if he quit his job because of all the real estate interest they had, and he just went and did real estate full time. So it's really kind of magical. And his wife was like surprised. So I know he's on here listening to this, and I tell his story frequently. I don't want to point him out, but really great. So we're going to do some questions here in a couple minutes. I wanted to get a little bit more into, I guess, for, physicians, for busy professionals, for people that are new to this. I remember, when I was kind of getting started in real estate, no matter where you're at, it's like, oh, I know I should be doing real estate. I'm not quite sure how to get started or what's the first step. And for people that have money, it's like, oh, I'll buy a rental or I'll buy a vacation home whenever we do this. And it's a time suck. So what are some tips to both educate yourself as well as actually take action and not get stuck in analysis paralysis? Why don't we start with Tom?
Yeah, sure. And it's pretty basic. Number one, you get on a panel like this. I mean, you listen to a panel like this, try to you get educated first. You kind of decide what you want to do, why you want to do it, and then start getting educated. There's a billion books out there. There's a billion podcasts. Like Buck's got one, Vic's got one. You've probably got. I'm like the only person on the planet that doesn't have a podcast. But there's all kinds of information out there. And to date myself, there were no podcasts, no internet, no nothing when I started, but there was still people. There's all the information online. Start learning about it. You'll find out what you like. And then there's people that do what you want to do. Go talk to those folks. You'll gather worlds of information from them. And so, you can certainly, as you mentioned, you get analysis paralysis. There's only so much you can learn. You got to eventually jump in somewhere. And you either go buy yourself a single family home, or now there's a plethora of opportunities to invest passively with other people. And if and when you do, I suggest, if you're really new to this, you find somebody that you know well, that's maybe invested with somebody for a long time, to understand how to decide who's a good person to invest with. That's like a whole seminar right there on the diligence on people you're investing with. And I suggest you start small. No matter, you can invest $25,000 or $1 million. The lesson that you're going to get is the same size. So while you're starting out early, just start small, get some lessons. As you gain confidence and experience, then you can start doubling down on things that you really understand, you really like. So there's a lot of opportunity out there. And they say there's risk, but you hedge your risk with your education and your network, the people that you're around. So that's my advice. Get around people doing what you want to do or have been where you want to go.
Yeah, absolutely. Education is huge. This is a topic that comes up often on the Mailbox Money Show, my podcast. I've actually had all of you guys on there at some point. We've had Ken McElroy, a bunch of others too. I know you guys, I know Buck has a podcast. I think Vikram, you got a show as well, right? that you're
I
doing?
do. Yeah.
Yeah,
I
it's
told you,
awesome.
I'm the only one that
You're
done
the
that
only one.
podcast.
Yeah, you're just playing your guitar and busy with all your. I remember it used to be Tom. I always admired because you would be like having your office. You'd go in and do surgery a couple days a week, and then you'd be having your hundreds of millions of real estate. I admired how you're able to balance all that. You had like both offices, and you were going back and forth. You're one of the only guys I knew that would actually really have a practice and do both. And now you're not doing both, right? You're
Yeah,
solely real estate now. Okay, so this is
yeah, not
retirement
too
for you,
crazy.
right? Is your focus?
Bronson, you
Right.
forgot to mention he's part-time real estate, part-time Indiana Jones. I see him like traveling the world. He's in
Love it.
India, he's in Mexico City, he's in, it's like where's Waldo? You have to figure out where's Tom Burns.
This is retirement, right? This is retirement. You're busy. So
Have something to
um,
do.
awesome. Love it. Vikram, why don't you give us your thoughts?
You know, before I do that, Bronson, how did you get your start in real estate, and what made you get started, man? Because medical sales it was a lucrative business for you.
Yeah,
And
for me, I appreciate that. I was making 200K a year. I was working probably 30 hours a week, would go into the cath lab and cardiology, working with stents and balloons. And we had a device that sanded calcium out of the coronary arteries. And hey, we also did a lot of OBL and ASC stuff. And it was interesting. It was good. I just didn't like that. And this is, I think, a common thing for physicians is that it was hard to do those travels. It was hard to take time off. I mean, when I was able to fire myself, I actually last year I was able to travel 6 times internationally, right? So I've been able to build my life around things that I enjoy, so I can follow Tom around and go, be Indiana Jones as well. But I think the idea of like most people say I want financial freedom, and it's great to know that you could quit working and not necessarily have your expenses covered, but excuse me, not your income covered, but your expenses. If you figure out what your expenses are, that's really the rat race number, right? So once I replace that, I feel like, okay, I'm free and I can kind of build on that. But really, what I wanted and what most people want when they say financial freedom is we want time freedom. And particularly in the medical field, that's the thing no one has is time. And so to be able to take a week, 2, 3 weeks off and go on a trip, that was like a dream. I mean, for anybody working anywhere related to the medical field, it's like how's that even possible, right? So that was the big impetus for me.
yeah, I love that. And then, I think there's three trades like we've all decided that we have to make in our life. So, trade number one is, time for money, right? And that's what all the doctors right now are doing. Trade number two is you trade money for time, right? And that's level two. That's where we all want to get to, where we buy back our time. And level three is, and again, the masters of real estate are here, Buck and Tom, right? So they trade money for money now, right? It's like the third level. That's the empire building stage. So I think doctors have to figure out, or the people listening have to figure out two things, right? Are they going to be active or passive? That's really the first distinction. And once they decide, hey, if it's passive, it's you. Tom's good friend Robert Kiyosaki says it's not the investment that's risky; it's the investor. And how do you de-risk the the investor? It's by knowledge and education. And there's all the plethora of books and podcasts and courses and things like that. But once they get educated, then the risk goes down dramatically, and then they can choose. I would choose an asset class. I would learn how to choose sponsors in an asset class, and once they do that, I would stick to that and not get too cute and not go too broad, and learn either geography, an asset class, a sponsor, or a couple of sponsors, and rinse and repeat, and then test the waters as Thomas is suggesting. Now, let's say you want to go active. Again, then you have to go choose Baskin Robbins. What flavor? Are you going to do RV parks? Are we going to do hotels? Are we going to do, student housing? Are we going to do multifamily? Are we going to do office retail? Learning to choose one of those asset classes. And I think a lot of us chose multifamily because we believe in asymmetric risk reward, right? Which is essentially like, mitigating the downside and really having a good runway on the upside. And so that's why I chose, like as a cardiologist, I like to stress test things. And so I stress test my real estate. And I think multifamily usually stands the test of time. And go back, 10, 15 years, the number one real estate asset class in commercial real estate was office. I think that's quickly been usurped by multifamily now. And that's where the big money, the smart money, whatever kind of adjective you want to put in front of money, that's where they're investing. And so that may be a good place to get started. And I think I want to thank in the chat, I think it's a Raman. He said he invested in 2 physician-led syndications. So, that's a good way to get started. Right. And, the question is some people can get disgruntled. Hey, I invested during deals that were bought in 2021 and 2022. Well, I think the whole country, was going through something. And so, I wouldn't hold the asset class or potentially the sponsor fully liable for that. It could be a macro trend, right? And so you may miss out on all the opportunities that are going to come, calling it 2023, 2024, 25 and onward, if you just say you get, using that one reference point. So just have a little bit of a wider stance on things. And then I really believe in that testing the waters with small amounts of liquidity. And then really, what is the game? Is this just a side hustle, or is this a strategy, or is this something you want to get into? And if it is, then you have to go start spending a significant amount of time. You may want to get a mentor, a coach. You may want to really get into this and really understand that this as a business versus a hobby, and really you can pivot like we've done, or just do this in parallel, but you just free up more time and free up less hours, and you're practicing medicine for the fun of it versus you have to.
Right.
Great. Yeah. Thanks, Vikram. That was wonderful. Buck.
What was the question again? I forget what the actual question was.
The question really was around, getting started as a physician, getting started as an investor. What are some steps to get there? What are some things that, people can do both to educate themselves as well as not get stuck in analysis paralysis?
So for me, as I mentioned before, my dad continues to be a real estate guy, in his entire life, and he bought small complexes, nothing ever that big. Maybe he'd buy 20-30 units somewhere at a time, but a lot of it, the money he made over a period of time, was just through duplexes, triplexes, and just they had tons and tons and tons of them. And the guy worked nonstop, and he liked it too, right? And that was one of the reasons why I didn't want to do real estate, because the phone rang off the hook, and there's all sorts of 4-letter words flying around all the time. He was working in sort of the low income areas too. He collecting rents with bats and things like that. But so I didn't want to do any of that. But one of the things the reason I bring all this up is that one thing that's clear is that you can, by doing some of that, you're on your own, you really accelerate your learning. So as much as I find that a lot of people graduate to the idea of investing passively with folks like us who do these sort of syndications, I really do like the idea of people, if they're interested, grabbing a house or a duplex and just understanding the concepts, the little concepts, whether they're the tax concepts, the concepts of how to increase the value of a property and those kinds of things. The first property that I bought on my own after reading Kenney McElroy's, because I never trusted my dad, right? So I didn't listen to my dad, but I did trust Kenney McElroy, and this was like, right after trading, I read ABCs of real estate, and then he had the advanced ABCs of real estate. Kenny's a great guy. I told him his story, and I listened to everything he said, wrote it down, and I went and bought a building, and I lost like 300 grand on that building. And that was the best 300 grand I ever lost, because I learned so much from losing and doing everything wrong. And I'm not telling you to lose the money or that was a good thing, but man, don't be scared of it, is my point. For me, real estate I have made a lot of money in real estate, but it doesn't mean that, there haven't been disappointments and losses as well. And some of this just comes with volume. Tom, you're a surgeon like me. What was the old saying? What's the old saying about a surgeon who's never had a complication?
He's a liar.
He's a liar, or he's just not done enough surgery.
That's true.
Right. So I think the important thing I would just emphasize is that real estate is like any other investment. There are risks. We don't want to sell this as something that's not risk. But what I will say is that the alpha here, the ability to make a lot more money quickly and leverage your money, is unparalleled. There's no way I would be, I literally probably would have 10 times less money right now, like net worth wise, if I was not in real estate. And that's not even I mean, that's just the reality of it. So, so I think if you approach it and say, I'm going to learn this, and I know that there's this alpha there, this opportunity that all these guys are talking about, and learn it and get involved, then you can figure out, at what level you want to do that. And I don't think you have to decide between being active completely or passive. In fact, if you want to do the real estate, if you want to do the real estate professional status like these guys are talking about, Tom Wheelwright will tell you if you get the real estate professional status doing active stuff, then you can throw in all of your passive stuff in the same bucket. So anyway, that's my take.
Yeah, that's really great. I want to do at this point, I want to take some questions. So I know we have some questions in the audience. And again, anybody feel free to ask questions kind of wherever you're at. We got some people that are, much more experienced, more advanced. We have people that are active, people that are passive, people that are just new and kicking the tires. Maybe you're wondering kind of what step 1, 2, and 3 is. I thought there's been some great dialogue so far, both from a kind of a higher level macro view and also just a very personal, here's how I did it and something we did. We'll kind of keep going on some questions here until we'll kind of have some questions on our own. But if you do have a question, please do drop it in the chat. We've got a few more minutes. We get to the end and then nobody wants to ask a question. Then all of a sudden we're like, oh my gosh, I've got 10 questions right at the very end. So put it in the Q&A, put it in the chat. We'll get to it as we can. So let's talk a little bit more about kind of where we see things headed from here. Maybe let's talk a little bit in terms of other assets, because I know that we've shifted a little bit to do from only multifamily, which we've had some deals that have gone great. We've had some deals that have had bridge debt that we've had some real serious challenges with. And then we've also, shifted in other things like ATM machines and car washes and oil and gas and other sorts of VC type of stuff as well. Are any of you doing any alternatives, or maybe talk about the assets that you like, both, professionally, what you're doing in your business, as well as even personally? Maybe to start with Tom here.
Sure. I've got my attention deficit. I've probably owned every asset. I haven't won on all of them, but I've owned them. So, I agree with Vikram. He talked about multifamily. Multifamily really does have it checks a lot of the boxes, and we're still undersupplied, and that's going to be, I think that's a good place to be for the next X amount of years. Certainly, office. I own medical office, which is a different animal than office. And those of y'all that are physicians, you don't move much. So I love having doctors as tenants, and I've had that for 25 years now. So medical office, still a good product, still pretty low cap rate if you want to pick up one of those. We have, in the sort of pseudo multifamily world, the built to rent world is really, I mean, it's been a somewhat favored asset class recently, and it's really getting more favored. I think the institutions have an appetite to buy stabilized built to rent portfolios. I think the demographics are pointing towards that. The millennials still, the generation that's coming up to home buying age still is there's still a big gap between renting and owning. And so they want to have a place to live, to start their family, and maybe a built to rent might be a little more palatable than a 3-bedroom, 2-bath apartment. So I think built to rent's good. And I'm fully aware that the institutions really like to buy those. Another asset class that I've moved into is sort of a workforce housing. It's the extended stay hotels. It's not your Sheraton, it's not your St. Regis or your, it's not a place where you go take a vacation. It's a place where people stay when they're working. They stay for relatively prolonged periods of time. Over 30% of people stay longer than a month. And a certain portion of them stay a year. So that's been a good asset class. So that's kind of in the real estate world. Still mobile home parks. Find the right operator. There's some really good cash flow and good depreciation on the mobile home parks. So that's all in the real estate world. And then some of the groups that I'm in, we certainly look at various stages, various seed rounds of private equity deals and VC funds. So that's sort of I would put that as a sidecar to once you get a nice stable real estate portfolio, but that's what I'm looking at.
Those are all very interesting assets. I'm just going to take questions kind of as they come between folks here too. but we'll keep working our way around. So Lube is asking, do we have to have X number of homes in order to get real estate professional status? The answer is no. There's 3 criteria. One is 750 or more hours a year of that you actually can document, and it's got to be 51% of your time, and you can't be passive. You've got to be active in some sort of role. Little article I wrote about it that kind of gets into some of that. Again, I'm not a tax professional, but that's kind of help. You can also Google that as well, or talk to you can reach out to me. I can send you a tax kind of strategist that can help with that as well. Vikram, what are your thoughts on what do you find interesting right now, both in your business as well as on a personal level?
Yeah, I think we all have entrepreneurial ADHD. It's hard to stay completely focused on just one thing, but we do our best. I run Viking Capital with my buddy Ravi, and yeah, we're really our goal was to, when we get to after $1 billion, our goal was to start diversifying outside of maybe multi. But right now we're at about 850 million, so we're close. Probably hit the $1 billion this year. And right now, we started off in value add, and now we've just run up the sort of the ladder of quality of assets. So we really operate mainly in the B and A space. And we're going to do our first ground up development this year. So we're excited about that. That will be an additional opportunity for us. And I do have some buddies. Yeah, I have a buddy of mine who's sort of mentored by Peter Linneman, and he has a very unique business model so we're thinking about learning about potentially partnering, and it's office to multifamily conversions in certain like very key locations in the country. And it's a very interesting strategy. So we're exploring that. We're also adding ESG to a lot of our strategies. So we figured out a way to make solar make sense financially, and we're exploring that on some of our assets. And then outside of that, I run a company called Limitless MD, where I help and coach and mentor physicians all over the country. And we help them in scaling their businesses, scaling their practices, and doing things outside of medicine, such as real estate. So that's been a good focus of mine. And I'm part of a private equity sort of startup that is looking to acquire dental practices and do a roll-up strategy there.
It's awesome. That's great. Yeah, lots of very interesting things out there for sure. So maybe Buck, you can answer that question as well. What do you find interesting personally, professionally, as well as somebody's asking if you are a billionaire based on what's online, that there's some celebrity gossip page that shows that you might be.
I'm not a billionaire. I think the confusion there is that, I mean, NetNet, I think it's probably have about $1.5 billion of assets under management.
Right.
Actually, this happened when I was interviewing Marin Katusa too. I was like, Marin, you're a billionaire? He's, I'm not a billionaire. but no, I'm not a billionaire. Yeah, okay. So let's say what am I interested in? So yeah, real estate, lots of real estate. Obviously, that's been sort of bread and butter for the last several years. Now, what happened with me was interesting in terms of investments, because I wanted to do other stuff. I wanted to get involved with other things, but I'm really good at starting businesses. I've started probably 6 or 7 successful businesses, but I didn't feel comfortable getting into investing in other businesses, or I just felt like I didn't have the skill set. So I actually managed to convince my brother, who was at that time managing the sovereign wealth fund of Bahrain, to leave his job and join me. So now I've got somebody who really knows how to look at businesses. And we started a broker dealer, and he's been really good. We've done some really interesting stuff. We're getting into, we've got some aviation stuff going on. We are literally buying a jumbo jet airplanes. We're leasing them out to American Airlines, British Airways, all these things. These are triple net leases that are protected by law, essentially. This is probably about as bulletproof as it can be. So it's a really great place. Depreciation is insane. It's better than real estate because of the fact that there's no real property involved. So we're targeting 100% depreciation with double-digit returns. So that's cool. We're doing, getting back to his, again, this is not stuff that I would feel comfortable doing, but he's, this is his sweet spot, mergers and acquisitions. He was one of the major players in mergers and acquisitions in the 90s for JP Morgan. So this is something that we're going to start doing. In terms of other things, I'm also a big fan, as people may know, of some of these interesting insurance products, particularly premium finance type things. Infinite banking. We have this thing called wealth formula banking. So I think there's lots of different interesting things out there. I mean, real estate is, I think for me, it's my core. I don't think it has to be everybody's, I'm 85% real estate, right? 85%. But it doesn't, I don't advocate for everybody to be that. But I think it needs, I think what people are lacking in their portfolios for the most part is alternatives, because alternatives is really where the alpha is. And it's interesting, even just talking to my brother, it's like, what does a country do? Like Bahrain, what are they doing as a sovereign wealth fund? They're doing a lot of equities, public equities, but they're doing a ton of private equity and private equity real estate. So modeling your own portfolios after like the way institutions do it, the way ultra high net worth do it, is probably not a bad idea, right? And you're not going to get that advice from your wealth manager, because they're basically working on how much money you've got with them. If they're getting 1% on your few million, couple $1,000,000 or whatever that you've got in with them, they're not going to want you to go take some of that out and buy real estate. So you got to get good advice, and you got to start thinking about managing your own investments. I think of managing my investments like yet just one more business. And I think everybody should get in that mindset, because no one else is going to care as much as you.
Right. That's very true. Well, guys, we're about the top of the hour. I know we're kind of getting some more questions come in here, and I know it kind of happens at the end. So I'd love to have each of you reach out to these guys. Maybe just take maybe 30 seconds each person, and just maybe even 20 seconds. Just, hey, how can people reach you? What's a good way to find you? Let's start with Tom.
Sure. I tell you, my website is richdoctor.com. Pretty easy to find. And if you want to contact me directly, just send an email to hello@richdoctor.com.
Okay, I put that in the chat there. Vikram, how can people find you?
Yeah, my website is just my name, vikramraya.com. And again, my email is vikram@vikramraya.com. You can shoot me an email.
Awesome. Buck.
It's a Wealth Formula podcast. Been around there for a while. So that's if you want to email me directly, it's buck@wealthformula.com. Also, if you're into the longevity thing, Sapio with Buck Joffrey, lots of interesting stuff there as well. That's how it's sort of a hobby of mine. So
awesome, gentlemen. I really appreciate you being here today. Appreciate all of our attendees. We had a pretty good crowd today. Or if you're watching this on a replay, we will have another event on the 16th of May. We're still finalizing some of the guests for that day. I'm sorry, not it's the 16th of May, investing for cash flow. So we've got a couple people confirmed. Really excited for that event. And thanks for everyone for being here, taking the time to educate yourself. Really, it all starts with education. When we learn, and then we can actually start taking the actions that help to lead to financial freedom. So just appreciate each of our panelists for being here. So much respect for each one of you for so many reasons. But thanks for taking the time to be here, bringing your audience, bringing your group here as well. And just really grateful. So thank you, everyone, both our attendees and our panelists. We'll look forward to seeing everyone on another panel.
Thanks, Bronson.
Thanks, guys. Thanks, Bronson.